Is the golden era for cash coming to an end? Interest rates are falling after the US Federal Reserve's bigger than expected rate cut. So where can you park your cash to get higher returns?
As rates moderate a little bit, people will still use cash management account because such account allows them to still earn a slightly higher return than leaving their money into the bank account that pays them very low rates. But at the same time, you would see more active management of it. So for example, if I'm selling my investments and I'm not investing my proceeds immediately, I might park it into a cash management account for a couple of months until I make my next investment.
Cash management accounts have the advantage of liquidity. But as they are investment products rather than savings, they are not capital guaranteed. This means you could risk losing your money. Investors have been able to get about 5% annually from money market funds. But analysts say this is not likely to last. And with the downward tilt in interest rates, it may be a good time for investors to lock in longer-term yields.
You can always lock in the rates right now by buying a longer tenure bond, right? So, there are government bonds that are 10, 20, 30 years in fact, right? So those bonds may still give a reasonably decent interest rate right now. So if you are really worried that, the rates will go down significantly in the future, you can always buy some of these bonds. And if the rates do go down, then these bonds will also appreciate in value because they are giving out a higher interest rate than the current market interest rates.
Despite yields falling below 3%, T-bills and Singapore savings bonds remain a place to park some cash, especially for risk-averse investors. But fixed deposits also offer relative security against market volatility.
I would say it's still a fairly good range for fixed deposits. Well, on the other hand, the Treasury bills are actually falling a little behind fixed deposit rates. So for investors or who are looking for a slightly higher, would think fixed deposits could be an answer. But then you will have to factor in whether you need that liquidity in the near future and if you can actually hold that on till maturity.
If you're willing to set aside your money for a longer period of time, you could also consider products offered by insurers.
Endowment plans that are maybe 3 years or 5 years in terms of duration. So that would typically give you a higher return on money that you maybe don't want to take risks on, but you have to lock in for that period of time. Otherwise, you may lose out in terms of interest or even suffer some penalties.
When interest rates fall, the yield on fixed deposits and savings accounts typically drops too. Even so, savers can take advantage of savings accounts that offer bonused interest.
For investors who want income but may not necessarily be keen to invest in stocks, there are some other instruments that could make sense. So a high interest saving current account can still give maybe 3 to 4% if you know how to hack it the right way. I would just try to look at the various bonus interest that I can get from different banks, different even digital banks itself, and then sometimes they like to give us this thing called promo rate or teaser rate for the first 20,000, first 50,000 of our savings. So we just hit that milestone so we can earn that higher interest, that promo interest, and then deploy the rest of our money into other savings account and also earn the promo interest there.
If you have US dollars in hand, you can also consider US Treasuries to earn a higher yield.
US T-bills currently pays a higher rate than Singapore T-bills. So some investors might prefer to just invest in US T-bills for that additional 1 to maybe 1.5%. So a lot more people in Singapore are actually investing in US T-bills. Also with the caveat here or with the consideration here that they may not be necessarily too worried about the foreign currency exchange rate because they might be okay holding on US dollar for their US investments as well, right? So if you take a very long-term approach, it might not really be, it might be a way for them to get higher returns without necessarily facing immediate foreign currency risk if they want to keep US dollars in the first place.
When deciding on where to put your cash, consider your liquidity needs and the purpose of your money.
The point is that you have to consider what you want to do with all these extra savings. If the point is to, just set it aside for a rainy day, then keep it in a high interest savings account with a bank. If the point is to potentially invest in the financial market when the right opportunity arises, then a cash management account still serves your need quite well. And if you just want to earn a slightly higher return without doing anything, then fixed deposits, endowment plans, and locking it up for 2-3 years could be the solution.
With the expectation that interest rates will continue to decline, the time for staying out of the market and being conservative may soon be coming to an end.
I do foresee that with instruments like T-bills becoming less attractive, people will look at other higher returning asset class. So this could include corporate bonds, that might give a slightly higher interest rates and a slightly higher coupon yield. They might also look at other asset classes like stocks again, or dividend-paying stocks, where your yield can be higher, but that also correlates with a higher risk.
When we factor in inflation, we give it around 2.8 to 3%. And so that's what the interest rates are now like for your treasury bills and your Singapore savings bonds. It's hovering around 3%. So I would say it's still something worth putting your money into, but increasingly you should shift the focus a little bit more into the growth potential of higher volatile instruments like your unit trusts, equities, corporate bonds.
Interest rates will always fluctuate, so the goal is to have a well-crafted overall strategy.
As long-term investors, we are always focusing on the fundamentals of good, smart investing where our portfolios are diversified and where we are also doing realignment and maintenance of our portfolio along the way to ensure that they are all on track. So don't be frazzled, don't be panicking because there was a rate cut. We should just stay calm and do what we've always been doing, sticking to the fundamentals.